Good morning, everybody. Welcome back to the Opportunistic Trader. It is just after 11:40 on December 19th, FOMC Day, and now it's also Department of Energy Day. And we're joined by Andy Lebow of Commodity Research Group, who joins us regularly talking about the Department of Energy release and crude oil. And as usual, for the past 3 or 4 months, there's a lot to talk about with oil. So how's it going today, Andy?
It's going great, Michael. What do you think's more important to the markets, the DOE report or the FOMC?
I think both of them actually are not that important, to be honest.
All right.
I think there's a lot bigger things going on, if you ask me, with whether it be China and trade and government shutdowns and price action, FedEx, and with oil. And you even just look at what's going on with OPEC and where we are. I think that the bigger picture things are bigger than these shorter term sort of data points for today. That said, a lot of action around it. But what's your take?
Well, my take is I tend to agree with you. I don't think the market is looking at it's certainly looking at the Fed the Fed today more than they are this weekly report. The big picture. This weekly report is not going to be all that important. But I guess people will be parsing what the Fed says with a fine-tooth comb. But.
Yep, So what did the data, though, say itself? And what's it, more so than not just even today, what's the recent trend of the data?
The trend of the data is not nearly as bearish as the trend in the price, that's for sure. Not even close. It's interesting that we've been talking about this big glut of petroleum that is developing, and everybody's wringing their hands about that. But if you look at the total U.S. inventories, they've actually declined by 14 million in the last 2 weeks, unanticipated, because I thought total inventories would rise. That could be. We'll see if that trend continues. And if you look, I always talk about days supply, which is inventory over demand, and right now our total days supply is 59 days versus an average of 62.5 days supply. So, and 60 is probably normal, 60 to 61. So we're a little low in terms of days supply. So that's the trend there. It's been a decline in total stocks. That's crude plus products. And on crude, we've been building stocks. Last week, we drew less than what the market was looking for. I was looking for like 3.5 to 4, and only came down 500,000. They are going to draw the next 2 weeks. We talked about this last week, Michael, because of LIFO and taxes. So we will see a draw and the rebuild in January. Gasoline stocks have been building. I thought they might stabilize and draw. They built by 1.7. Gasoline continues to be a little bit long, and distillate drew by 4.2, and day supply there are 7 days behind the 4-year average. So distillate still is pretty tight. And then, of course, the big number that a lot of people have been focusing on is Cushing. Cushing stocks built by 1.5 million. That's 20 million since we troughed earlier in the year. I think we're going to continue to build that Cushing probably by another 10 million over the next couple of months, and that's certainly bearish for structure anyway. And you could see in the at least the WTI spreads, they really can't get out of their own way. And the other key, the other important factors on the demand side, we had a great week this week. It's only 1 week, but we're not really seeing any evidence of demand falling off the table. In terms of end user demand, at least here in the U.S. Globally, it's possible. The price is the price. But demand was pretty good. Demand was excellent this week. So,
So, everything you're telling me is things are tight. We have less inventory, 59 days versus 62 days.
right.
So what's the disconnect here? Because prices have just gotten crushed for the
Oh,
past four
prices have
months.
they've gotten completely crushed. And, I think some of it is, this is this is the U.S. inventory. We're probably, I said it's been the last 2 weeks that we've declined, but probably in October, November, inventories inventories did build. I think that what's happened to the market is we've seen a tremendous increase in supply from May to now, and there was definitely a surge in demand prior to the sanctions being imposed on Iran, and that demand probably. Definitely borrowed from fourth quarter demand. So at the very time that the Saudis were increasing production were increased production to a record of 11.2, and the U.S. increased and Russia increased, was at the same time that at least demand for the marginal barrel dropped dead. People were covered. And all of a sudden there's this huge supply on the market. And the buyers were stepping back because they had already bought.
Right.
And you add to that, certainly you also add to that, all the macro concerns and the concerns about demand. But the point is, it's really not in the evidence yet. But the price is the price. It has come. It's come off, as you said, from 77, which in retrospect shouldn't have been, down to 46, which we may see in retrospect it shouldn't have been either. In fact, I suspect that's going to be I suspect we'll look back.
Oh, you mentioned before we went on that you had some thoughts about why yesterday's sell-off was so severe. What were the thoughts you had on
Well,
that?
I think that what happened, there seemed to be apparently one of the OPEC quote unquote sources, and within OPEC and then within the trading community, was talking about, hey, you know what, the Russians aren't cutting back until February or March, and we might not cut back. We might not cut back either. And the market began to freak out about that. With so badly that Al-Fali had to come on this morning, and say, "Whoa, the Saudis are committed to a cut. We are cutting back," and I think it definitely Fali's statements that the market is going to be balanced in 2019. I think served to lend to soothe the market. Because there were a lot of raw nerves yesterday, and of course one thing led to another. You had a technical. You saw the charts, Michael. You could see what was going on, right? We broke down, and there was a lot of scuttlebutt yesterday, which Al-Fali, I think, put his foot down today.
Yeah, well, I even saw some messages that, there's differing information about where, companies are break even, where companies are operating in a loss, where certain governments, where certain countries. What's your sense on that? Like here, even at $50 a barrel, are people making money, or do they need it at 55? Like I saw something that Saudi Arabia's break even was well above 60.
The Saudi, no. I mean, the Saudis break even is like that. I mean, that may be for their fiscal. Some people throw fiscal numbers out at 88, but their break even is these wells are down to $3, $4, $5. I mean, there's the Saudi break even is much low. Is significantly lower. But if you add what their fiscal needs are, they're much higher. So you have to separate what the fiscal is and what their actual economic break-evens are, because some of that, they're super giant wells that are still running from the 1930s and 1940s. Those are $3, $4. They're really low. The Gawar in particular. But in any event, I think you look at the U.S. break-evens; they're all over the place. The Permian break-evens, the average is probably, for a new well, it's probably 48. But some producers have down into the low 30s, some are into the 60s or 70s. It depends where the well is. It depends where the well is, and each company's own economics. So it's really hard to put a number on it. But I think it's a good question, Michael, because next year, the Permian production this year was up 1 million barrels a day. Next year, it's expected to be up 800 to 1 million. And, should the market stay down here? And remember, the Permian producers right now, they're not getting what the screen is. They're -8, right? Midland is 8 under the screen. So, they're getting under $40. For some of their barrels, right? I mean, not for some, for it's $40 for or 38, 39 for a Midland producer.
So what about in the U.S.? Can the individual companies, whether it be Marathon, a lot of the oil companies, whether they're looking at refining, whether they're looking at ethanol prices, the whole package here at $50, or we're below 50 here, but around the $50 range, is it something that is going to create stress and thus, shutting down production, shutting down new projects, things like that?
They're beginning to look at it. I think that we just got here, so yeah. I think we're probably
we're at like 58 like 6 days ago.
Yeah, we just got here, so I don't. They're beginning to look at it. There are some reports in the press that some capex expenditures will be will be lower, but I think we'd have to be down here for more than one day for a trend to take place. If we were, I would expect that the capex expenditures are going to decline. If you look in the Bakken, things are much more expensive than they are in Permian. In Eagle Ford, it could be a little bit less, but we might see some declines, and we might see some declines in the Bakken. Offshore, those are big capex expenditures, and there's long lead times, so those projects don't get cut. But certainly some of the shale projects, there's a big drilled but uncompleted wells inventory that wouldn't be brought in now, right, at these prices. I think it's something that the market's going to be watching pretty carefully. Right now, what
are you watching closest right here over the next 4 weeks? Like, what do you think is going to be some of the really important drivers, especially as where we are here at these extreme levels, below $48? What are the 2 or 3 things that you're really looking at?
Well, remember, the key thing over the next 2 weeks, these production cuts aren't going to happen, right? So until January, February, and really it's going to be March, where the most of them are going to be in effect, February and March. But I guess what I'm really watching, and I mentioned this last week, is I'm watching the Brent spreads to see if there's any daylight there. It looks like Feb, March, and March, April are beginning to move backwardated. The back of the curve is kind of lagging. But I think maybe in the Brent spreads we'll get an indication, if the market's tightening up in the front. And in fact, the M1 minus M2, the first month of the physical market, did go backwardated. So there's something, I think you have to start watching the physical markets, to see if they really tighten up. In the U.S., like I just mentioned, the WTI spreads really aren't getting out of their own way, but that's something to watch. The data, the next 2 weeks are all our holiday numbers, so they're not going to be that, they're not going to be that instructive, unfortunately. So yeah, those are the things I'm going to be watching. The physical market and the spreads to see if if demand is beginning to pick up again. It's not going to be the next 2 weeks. It's going to be more January and February.
Yeah. All right. Well, I really appreciate it. Andy Lebow, Commodity Research Group. Great work as always. He's making some time for us. He's been on TV, Bloomberg, and what was the station you were on just before here?
BNN, which is the Canadian, the Canadian Bloomberg station. I'll send you the link when I get it, Michael.
Excellent. I'd like to see it. Well, good work as always. I appreciate it. Andy Lebow, we'll talk to you later.
All right.